Good morning, good evening, or good afternoon, depending on what time of day it is you're listening to this. And welcome to Farm Credit Services of North Dakota's virtual farmer meeting. We're going to kind of go over some of the crop insurance changes this year and try to give you a little heads up on what's happening. So with that, we're going to get started. All right. Start things off, Farm Credit Services of North Dakota made a little bit of a philosophy change. We updated our vision statement to, we will be an invaluable partner and trusted advisor to agriculture in rural America. We also made some changes to our mission, is to support the aspirations of vitality of agriculture in rural communities. These have not been updated in a while, and we decided to kind of change and do a little bit of adjustment to those. Now, at Farm Credit Services in North Dakota, we have a lot of products and services that we do offer. Some of the things we offer would be operating loans, real estate machinery loans, young and beginning farmer benefits, crop insurance risk management, and online and consumer banking. Another thing that we've done that's a little bit different this year, this is a benefit to our co-op owners. On the lending side of this, we've gone out and we're giving out a cash dividend. And this is for anybody who would happen to carry a loan with us here at Farm Credit Services in North Dakota. We will be giving out cash dividends here, basically the end of March for all of our loan customers. So that's new and exciting. If you have any questions on our new cash dividend program, please feel free to contact one of our loan officers at one of our branch offices. They would be happy to help you out and give you some more information on how cash dividends are working here at Farm Credit Services in North Dakota. Now with that, we're going to get started on some of the crop insurance updates. Do note this is kind of a waiver, I guess, so to speak. We're going to give you the best information we have at the time. And today is February 17th, 2021. And this is the information we have at this point in time. Now, this information does change, but we do try to give you as good information as we can. So with that, let's get started. Farm Bill information. There have been a lot of government programs here in the last few years to try to keep track of. We've had the PP top-up payment that came out a couple of years back. PLC and ARC signups, we do have to do those. And do note that we are going to have a sign-up for PLC or ARC March 15th, 2021. So make sure you're ready to go in and sign up for either the PLC or ARC programs. We've had MFP 1 and 2. Those have come out and been paid. WIP Plus has had some interesting things done with it. Do note that WIP Plus also has a new program that's out right now. This happens to be the QLA. This is the Quality Loss Adjustment Program. How does this item work? Well, basically, you look at the 2018 or the 2019 crop year. And we're looking for quality issues on crops. Something that the elevator maybe reduced the price of your commodity because it had some quality issues. If you had some of these things occur in 2018 or 2019, there's a sign up for this, and that date happens to be March 5th. You will need proof that you had a quality issue, and you'll also need proof that you have reduced value. This could be assembly sheets that would show quality issues on them and prices. So do be aware of that. If you have any questions on that, feel free to give one of our crop insurance specialists a call. They can try to help you out on that side of things. And don't forget, the sign up for that one would be March 5th, 2021. So that is right around the corner. Okay, we had COVID-1, we've had COVID-2, and we should have hopefully some PLC / ARC payments coming out in October of 2021 for the 2020 crop year. Now, sign up on PLC and ARC is March 15th. Now, do note that we don't really have any prices for 2021 yet. We still have not finished off the 2020 market year yet. So that makes this a bit of a challenge to try to decide where to put your base acres. And it's going to be a bit of a tough decision. Now, what are we looking at? Well, we're looking at ARC County, which would cover some county yields. If we happen to have a county disaster, it could trigger an ARC County payment. And PLC is dealing with price issues. It's covering price loss. So that's where that one comes into play. Let's take a look at some of the numbers that go into these. Now, I'm going to show you the December numbers, and then I'm going to show you January, and then I'll show you the February numbers so you can kind of see what's happening to that market year average. What I've got here is crops in one column, the reference price in the next column. Now, 2020 market year average, where it's at as of right now, this is the latest number I've found, and then what the payments could be potentially for 2020. Now, we have not finished the market year yet, so these numbers will change, but this is the best we have right now. So looking at December, look at wheat. We went from 550 reference price. Market year average was running at 470, which that was an 80-cent difference. That would have meant we would have been looking at an 80-cent payment. The barley was at 40 cents, and oats, corn, soybeans were not paying, and the canola was at about a little over 3.5 cents. Now let's take a look at this and see what's happened. You look at January now. We've lost a little bit of payment on the wheat side. We went down to 65 cents. We've lost a little payment on the barley as well, going down to 35 cents. Canola's gone down a little bit, but they were still there. There's some payments. The oats, the corn, and the soybeans did not have anything there. Now, this is the most current number we have. Looking at this one, the wheat, we're looking at about a 50-cent payment right now. We've lost 30 cents on that since December. So that number is going down. And we have not finished setting these prices yet. Barley's gone down to that 25 cents. Canola's gone down a little under 3 cents. I mean, we've lost a little bit of the payment. Plus, if you look at the corn and the soybeans, those numbers, the gap has gotten even wider there. I don't think you're going to see any payment on corn and soybeans in the PLC side. It's just there's too big of a gap. Now, remember, I said we are not done setting our market year average yet. And the reason being is we haven't finished that 2020 crop year as far as pricing goes. For wheat, barley, oats, that price is set from June 1 of 2020 to May 31st of 2021. So we still have a little bit of time to set some pricing there, and that market year average will move. If you look at dry peas, lentils, canola, and flaxseed, it's July 1st to June 30th. And then the soybeans, the corn, the chickpeas, sunflowers, mustard, safflower, and cranberry is September 1st of 2020 to August 31st of 2021. So we're still trying to set a market year average for the 2020 crop year, and we're signing up at FSA by March 15th for the 2021 crop year. That's the challenging part. We're not sure what these markets are going to do, and that's the scary part when we go in and sign up. So let's take a quick look and see how these programs work. The first program we'll look at is basically for barley. This is Ward County barley. Here's what we take a look at. First thing we need to do is we need to figure out a county yield. How do we do that? Well, we look at 5 prior years and we eliminate the biggest county yield and the smallest county yield. Then we average the 3 middle numbers out. For Ward County barley, that happens to be 75.39. Every county will have a different Olympic yield. That is unique to the county it comes from. The next part is the Olympic price. Now that is set on 5 years again of market year averages. You get rid of the highest price and you get rid of the lowest price, and you average those 3 middle numbers out again. Now this number, that $5.07, that is the same for everybody in the United States. So a unique Olympic yield by that county, and then an Olympic price that's the same for everybody. I multiply those two together and you get your county benchmark. And for barley in Ward County, that number is 382.23. If I take 10% of that benchmark, that's the max that our county could pay. So in Ward County, your max payment could be $38.22. Now let's see if we could trigger a payment. Well, you take your benchmark of 382.23 and you multiply it by 86%. ARC County has a built-in 14% deductible. That's where the 86% comes into play. That gets us to $329 about. That would be like the county guarantee. So for Ward County Barley, the county guarantee is $329. Now, we're going to have to run a scenario here. We're going to take a look. Let's say that barley in Ward County runs 70 bushels. Now, I don't know what Ward County barley ran yet. They haven't released that information. So we're just making a guess here. But let's say it was 70. If I take 70 bushel barley times the market year average right now is at $4.70, that gets me to $329. That's the break-even yield. In order to get paid on ARC for barley in Ward County, the county yield needs to come in under 70 bushels. If it comes in at 70 or higher, we basically don't have a payment there. So kind of remember that. Now, second program. That program is PLC. This is a much simpler program than the ARC program. We're basically looking at two numbers. Reference price. The reference price for barley is $4.95. And then we're looking at the market year average. The market year average for February as of right now for barley is $4.70. Now, what do? We take a look at those two numbers. I take $4.95, that reference price, and I subtract from it the $4.70, and that would be the market year average. Now, remember, we haven't finished this year's market year average yet because we have a few months yet to go, but $4.70 is where it's at right now. So we'll utilize that number. That's a 25-cent payment. Now, what do I multiply that 25 cents by? I'm going to multiply that by your FSA farm yield. The FSA farm yield, not your crop insurance yield, your FSA farm yield. So we'll say on this farm at FSA, we have a yield of 70 bushels for barley. We take our FSA farm yield and we multiply it by that 25 cents, and that would give us our payment. That's kind of how this works. Now, also remember, ARC and PLC both pay on 85% of your base acres. All right. Next one we'll take a look at is canola. Canola, again, same type of thing here. We take an Olympic County yield, and Ward County canola is 2,100 pounds, a little over. We multiply that by the Olympic market year average price, and for the nation, that's a little over 20 cents. We get a benchmark of 423. Now remember, 10% of that is our max. Multiply that by our 86% to take into account the deductible, and that gets us to 364. Well, let's say Ward County canola runs 2,000 pounds. I take that times that 1725. That's where the market year average is running right now in February for canola. Not done yet, but that's where it's at now. That would get us to 345. Subtract those two, we get $19. What's the break even? 2,110 pounds. That's basically the yield. If Ward County falls below that, we trigger an ARC payment. If it goes above, no payment. All right, let's look at the PLC. Canola has been a very good PLC crop. It's paid pretty much every year. We've been below that 20 cents, so that's why we've been triggering losses. So you take the reference price of 0.2015 and you subtract from that where the market year average is at. And that's that 0.1725. The difference there is a little, just a tish under 3 cents. So that 0.0290. You multiply that by your FSA farm yield, and that's where we'd get $58 on this one. Canola's been a pretty good PLC crop, and it looks like it will pay again in 2020. And it's been a heavy PLC crop. I'm guessing it's probably going to be utilized there again just because it's paid out a lot. And if we get well above a 20-cent canola price, that's not a bad number. We can sell our canola and make some money that way and not have to worry about it. So that's kind of how the canola one looks. Corn's a little bit tougher. Corn, the Olympic yield is 111.36. The problem is that Olympic price is at 370. And that's well below where we're at right now as a market year average. That gets us to 412. Take that times the 86%. 354 is kind of our county guarantee. Well, what happens if we run 100 bushel corn in Ward County? Take that times $4.30. That's the market year average right now for corn. That gets to $430, well above the 354. Where's the break even? 82 bushel corn for Ward County. I don't think we're going to trigger an ARC payment on corn. Now, if you look at the 430 market year average, compare that to 370, I don't think we're going to trigger a PLC payment either. This is a bit of a tougher decision. Where do we put our corn base? Well, you got three kind of options here to take a look at. One of them is if you think you're going to have a county disaster, we're dry, Ward County's not going to make it, you could put corn into ARC County. It's just one of those things, you eliminate that risk on the drought side. Now, if you think that price is going down, we're never going to hold 430, you could go PLC. Now, you can also split your base acres if you want to. That's up to you by farm. And then if you do that, take your higher yielding farms. Those would be your PLC farms because a higher yield could trigger a bigger payment. Your lower yielding farms will go into ARC County. The reason being there is all the payments are based off of county numbers. Okay, so that's one thing that you can look at as well. So those are kind of the options. Corn is a tough one. Now, there's also an SCO product that you can buy as well. And that only works if you sign up for PLC. We will talk about SCO and ECO later in this meeting, so you'll get an understanding of how those two products work. All right, soybeans. Soybeans are tough as well. You look at this and you take that Olympic yield times that Olympic price of 925, and that's that 306. Take into account the deductible and your guarantees at 263. Well, what happens if Ward County runs 31 bushels? Well, 31 bushels times that 1115 market year average right now, that's not going to trigger a payment. What's the break even? Looks like about 24 bushels. So that means it's got to go below 24. I don't think we're going to see an ARC County payment on soybeans. Now, if you look at the PLC side of it, the 1115 compared to 840, probably not going to see that as well. So what do we do with our beans? Well, if you want to look at history, you would probably go ARC County just because we've never really triggered PLC payments on soybeans. But on the other side of it, if you want to buy an SCO product on your soybeans, then you're probably going to sign up for PLC soybeans because the only way you can buy SCO is if you are signed up for PLC. Now, remember, we will talk about SCO in a bit, and SCO does cost some money. So that's another thing you'll have to think about. But when you're signing up, soybeans are, they've never paid on PLC. You could go ARC County then and think maybe we're going to have a county disaster on the yield, or you can sign up for PLC and then you can say, you know what, I'll buy crop insurance to cover my top end on a county-based level. So we'll talk about that too. And the last one we're going to take a look at here is wheat. Now, wheat is a little tougher as well. 2 months ago, I thought wheat was going to be a very heavy PLC crop just because we had an 80-cent payment. That number's come down. So let's take a look. Ward County Olympic yield at 51.47. The Olympic price is at 550. So I multiply those together and I get the 283.09. Take into account my deductible, multiply by that 86%. That gets me to 243. What happens if we run 45 bushel wheat? Take that times $5, where the market year average is at right now, and I get $225. Subtract those two, I'd get an $18 payment. The break-even yield for Ward County wheat is 49 bushels. That's kind of triggering the payment or no payment. Now, if I look at the PLC side of things, 550 reference price, $5 market year average, that's a 50-cent payment. Multiply that by your farm yield, and you can get, basically, if this farm had a 45 bushel yield, that's $22.50. Again, paid on 85% of your base acres for both of these products. So what do I do with my wheat? Well, if we think that price is going to level out, maybe go down, we can stay PLC. If you're worried about a county disaster and you think we're not going to be able to grow a wheat crop, you could go ARC. You can split your base acres up as well. Don't be afraid of doing that, because if you go that route, high yielding farms, remember, are PLC farms, lower yielding farms go ARC. Now, Also, if you're going to look at SCO, remember you want to be signed up for PLC on that side of things if you're interested in buying SCO. All right, with that, that is kind of enough of the FSA programs. Those are some things. If you have some questions on some of those things, feel free to give one of our crop insurance specialists a call. They'll help you out and kind of answer some questions. So that kind of takes care of that portion. We're going to go in now to the crop insurance side of things. Now on the crop insurance side, we've got some dates coming up. Remember that March 15th date? That is our sales closing. We've got to elect our levels of coverage. We got to select the options we want to utilize, look at unit structure and some other things. So make certain you're coming in here basically anytime soon and taking a look at your crop insurance options. Early and final plant dates, be aware of those. Those are county specific, so they change from one county to the next. Production reporting. Please, please, please turn your production in soon. We need all of your 2020 production in order to quote your policies correctly. So if you haven't turned your production in yet, get it in. We need that so we can run your policy correctly. And you have until the 29th of April to adjust it if you need to. The acreage reporting date, July 15th, and the premium due date is August 15th. That hasn't changed. Do note this, that means your premium is due September 30th. Has to be postmarked by September 30th. Interest does attach October 1st. The last couple of years, we've had some extensions to that due to COVID and some other issues. I don't know if that will happen again this year, so just plan on a September date, and if it gets extended, it gets extended. So we'll work on it from there. Okay, moving on, production reporting. Make certain you keep track of good records and that you turn your production in. Now, whatever you turn in as production, make sure you have documents that can support that. All right. If you've sold all of your production, you can put production sold. Then make sure you're putting down exactly what you sold. That number should be exact. Now, the next part is if you haven't sold all your production, you might have some still in the bin. Maybe you were using truckload logs. Then we'd use the field harvest records. That's how we figured out our production. Or maybe you measured bins by somebody. You could put that in. Just make sure you have a reason for putting down what you put down. All right. And make sure you can support your production. Also, as far as production reporting, we would like to see production reported by optional unit. That's by section. If you ever want to go back to an optional unit, we need to have production basically from one section to the next. So make sure we have that. And make certain we have a signed production report. Get that turned in, taken care of, and signed, and we'll take care of the rest. And then support your production. Why? I don't want to see people get assigned yields. Make sure you have good records. Now, example one here, I reported, let's say 10,000 bushels. We find out in an audit that I actually have 11,000 bushels, so I underreported. We can correct the databases and move on. Now, the example two, I reported 10,000 bushels. We find 9,600. I'm within 400 bushels there. That's 4%. So I'm okay here. We can kind of move on and keep going. Now, in the third example is where we're going to run into some problems. I reported 10,000 bushels. They find 9. I'm off by 1,000. That's 10%. That's over the 5% tolerance. I will have some issues here. I could end up getting assigned yields. Assigned yields are 75% of the prior year's approved yield, and it goes by crop and by share, basically. So it's not just the unit that you messed up. It would be all of your units that had that crop from that year, basically, is kind of what we're looking at. Don't want to get assigned yields. So the important thing here is make sure you've got good records, records that support what you put down on the production report. Okay, enough on production reporting. Livestock. Make sure if you're feeding your livestock that you guys are basically letting us know. And what I'd like you to do here is just tell us before you start feeding so we can have an adjuster get out and measure whatever you have. That way we know your production and you're good to go. So we get it measured. Beginning farmer rancher, this is a BFR, and it's a good deal for anybody who happens to have 5 years or less experience. Your crop insurance specialist will help you take care of this and get it set up for you. It gives you some discounts and can help you build an APH too. Now, the veteran farmer rancher is for anybody veteran. I mean, if you served in the armed forces, this is a great way to get a little bit of a discount and to help build an APH as well. This works for 5 years as well once you've got out of active duty. Okay, native sod. Native sod is something that we just want you to tell us about. We need to know about it so that we can kind of take care of it. So basically what we'd like you guys to do, if you broke anything out that wasn't broke out in 2020, make sure you let us know so we can help take care of that. And let us know here in March or the end of February so that we can take care of this early. Conservation compliance, make sure you have that AD 1026 filled out at FSA, because this will affect basically subsidies, your discounts. It will also affect any FSA programs you've been involved in. So have that 1026 filled out. One thing to be aware of is just basically comparing optional units to enterprise units. The discounts on the enterprise units are pretty substantial. It does make the premium a lot cheaper. So if I look at a 7100, the discount is basically they're taking care of 59% on an optional unit. On an enterprise unit, the government takes care of 80%. Why? Because on enterprise units, you guys are taking on a lot more risk. But it is going to be substantially cheaper premium because it's kind of like you're taking on a bigger deductible. That's why you get the discount. So enterprise units are a great thing. They're cheaper, but they don't fit every farm. Take a look at them, see what you think, find something that fits your needs, because enterprise units are a lot cheaper, but they're not always the best coverage. So take a look at them, see what you think. RMA prices. Now, the one thing I will say, RMA prices are up substantially compared to where we've been at in the past. You look at spring wheat right now on the 17th of February, we're running at $6.47. Durum, $6.72. Canola's at 20 cents. Corn is at $4.52. The sunflower oil is at 0.215. Confectionery sunflowers are at 0.267. Soybeans at $11.68. And barley's running at $4.14. This is our projected price. This will kind of set some guarantee for us. Now, the other thing I want you to be aware of is the 2021 volatility factor compared to the 2020 volatility factor. This is how volatile our markets are. How much are they moving? Notice in 2021, our factor is substantially higher than 2020. What does that mean for us as producers? That means we're probably going to be paying a little bit higher premium. A volatile market increases that rate. That rate means we pay more premium. So just be aware, we've got higher projected prices, higher spring prices, and a higher volatility factor. Our premiums are going to be higher than what they were in 2020. But our coverage per acre is also going to be higher, and that's a good thing. So moving on. APH established prices, oats at $2.47. Anybody have bad potatoes at $9.05? Sugar beets are at 0.146. The flax is at $10. Forage seeding at $1.63, and safflowers at 22 cents. Now, this is kind of a comparison to where we've been at with prices, and we are a fair amount higher right now than what we have been historically if you look at the last 4 years. With the exception of 2018 on wheat, most of these numbers are substantially higher than where we've been. So that's kind of a nice thing too. Revenue. Where on earth are we finding these prices? Well, for peas and beans, RMA is collecting some data and they are setting a price. That price will get released here about the 5th of March. So that's when we get to figure that one out. If you look at barley, barley price comes off of Chicago Board of Trade coming off of corn futures. Wheat, Minneapolis Grain Exchange is where they're pulling that. Sunflowers are coming from Chicago Board of Trade based off soybean oil. Canola is coming off that ICE board out of Canada for November, and soybeans and corn both come off Chicago Board of Trade. So that's where these price discovery prices are basically coming from, just so you're aware. Now, options. I do like options. Options are a great way to enhance an APH and help boost it a little bit. Now, options can be expensive. Remember, I told you to get your production in so we can quote it. This is why we have to quote these options. We got to figure out, is an option worth the expense or not? And the only way to do that is have all of your production turned in so we can quote it. We're going to take a look at some of these options. Quality loss option is brand new for 2021. This will be the QL option. What does this do? Well, it allows you to put in your actual produced yield rather than a crop insurance reduced down yield. So what do I mean here? Here's a good example. 2019, I had a loss on my wheat. What happened was I actually had 50 bushel wheat out there, but it had some quality issues. So crop insurance reduced my bushels down to 25 bushels. What went into my APH then? The 25. So my yield, my approved yield would have been 43 bushels. But by putting the QL option on, I can boost that up to 46. Now, here's the other thing we can take a look at. Let's say, what was the premium going to be? For a regular, that 43, if we were running a 580 price, and actually that price is higher right now, but it would cost me $15.86. If I would have put the QL option, I'd gain that 13 bucks, but it's going to cost me about $3.60 or so more than where I was at, or 60 cents. So is that worth it? Enterprise unit has a little more bang for the buck. To get the same $13, I'm paying about $1.60. So that's kind of how that one works. A good one to take a look at, good one to quote and see what we can use. APH yield exclusion. This is basically if the county had a bad year and the county has to qualify. Do note that a county qualifies. We can remove that year kind of from your database so it doesn't hurt you. That would be yield exclusion. If the county had a bad year, we can then take that year and we can remove it out of your database if you would like to. But the year has to qualify for that county. Trend adjustment. Now, trend isn't a bad option either. It's one of those things that farming practices have changed in the last 20 years. You look at the things we do now, we maybe didn't do 30 years ago. We're using things different. We're spraying different. We're planting different. We are using different fertilizers. We're doing a lot of things different. There's better genetics out there as far as the seed goes. We're able to produce more bushels. What's trend do? It allows you to increase your APH. If you have old history that's like 10 years old, you can boost that yield up a little bit. So that's kind of how trend adjustment works. Floors are allowing you to use basically a county T yield for your APH, or you could use your personal T yield for your APH. So if I've got a unit that maybe had a couple bad years on it or something, I can replace my yield with the county T yield or my personal T yield. So it's kind of a nice option there as far as a floor. And now what is a cup? A cup basically prohibits a unit from dropping more than 10% in 1 year. So that's what a cup does. It cups it from falling too far. Not a bad option either. Lots of options. Got to go through and quote them and got to take a look at them. All right. Okay. Unavoidable third-party damage. What is this? This could be spray drift. This could be livestock damage. It could be a fire that was caused by, a car that caught on fire or a cigarette that got thrown out the window, something like that. You didn't do it, but it's not a naturally occurring problem. What can we do here? We can take the damaged acres that are in that field and we can pull them out so they don't hurt your yield for the field. You still have to pay premium on all of the acres, and crop insurance does not cover third-party damage. Do note that. But what it allows you to do is basically that third-party damage does not hurt your APH. So that's kind of the benefit of that. If you have a third-party situation, make sure you let us know. We need to turn a loss in. We need to get an adjuster out, and take a look at that field so we can get everything taken care of and ready to go. Multi-county. Multi-county was brand new last year and allows you to take two counties that touch, they have to touch, and you can put them together and turn them into one enterprise unit. So you can get the enterprise unit discount on a county that you couldn't have because you maybe only had one section in that county. So let's take a look at how this works. We're going to look at first the upper left-hand corner. And this is where I have County A on the left and I have County B on the right. Now, on the left, we got County A. I have 2 sections planted of corn. Those are my green C's, and there's at least 20 acres in both of those. And remember, this is planted acres, 20 acres planted in 2 different sections. So County A will qualify as an enterprise unit on its own. That's good. Now I look to the right side, I have County B, 1 section planted, at least 20 acres there of corn, okay? Doesn't qualify because it's a section by itself. So what can I do? I can put the multi-county on, and I can bring County A and County B together and turn them into 1 enterprise unit. That's kind of how this works. 1 county must qualify on its own. The other county cannot qualify on its own, so we put them together. So as you can see, the blue spring wheat, or soybeans, excuse me, the blue soybeans, I've got 2 sections planted in County A with at least 20 acres in both sections. 1 section planted in County B, I can multi-county that as well. And then I've got my wheat. On the left, 2 sections, 20 acres planted in both of them. And on the right, 1 section, 20 acres planted at least. So I've got where I can do my multi-county on that. Now, top right-hand corner, look there, I've got 1 section of corn in County A, 1 section of corn in County B. Neither one of those qualifies by itself. So I cannot multi-county the corn here. 1 county has to qualify for an enterprise unit by itself. The second county cannot qualify. That's how it's got to work. Now the bottom middle, notice on the left, my corn, 2 sections planted of corn, 20 acres in both. And I got 2 sections of soybeans planted, 20 acres in both. So corn in County A is an enterprise unit. Soybeans in County A is an enterprise unit. Now, if I look at County B, 2 sections of corn again, 20 acres in both planted. That means County B qualifies for an enterprise unit by itself. I'm not going to mix those together, 2 different enterprise units. So that's kind of how multi-county works. All right, some actuarial changes. We've had some changes basically into our buckwheat, and basically what it was changed from no type specified to spring. Also added Golden Valley, Mercer, Morton, and Oliver in the state of North Dakota, Dawson, Fallon, and Wybucks in Montana. And Camelina, what was changed here? It just went from summer fallow and continuous cropping to basically a non-irrigated. So that was the change there. Soybean expansion, we've been doing some expansion. And as you can see, the 2 red counties here, those were counties that were added in 2021. The blue, the orange, the green, the gray, those have already been soybean counties. So all of the colored counties have soybeans as an insurable item. And as you can see, the red ones we added were McKenzie County in North Dakota. We have a 19 bushel T yield, and Richland County in Montana has a 15 bushel T yield. All right, corn expansion, we added Williams County. So anything colored in this one now has grain corn. So Williams County, North Dakota added grain corn with a 74 bushel T yield, and Billings County in North Dakota added grain corn with a 75 bushel T yield. So you can see your colored counties there. Dry beans, what did we add? Cavalier, we added some small reds, and in Sheridan, we also added small reds. Okay, so a little bit of dry bean expansion. Dry peas, Cavalier added fava beans, and these are the large and small Kamuli and Desi's that got added to Emmons County. Wheat changes, some minor changes here. Our staff will take care of these databases for you. And basically it was continuous cropping in summer fallow in McHenry and McLean County. Those now became irrigated and non-irrigated wheat counties. There's no longer continuous cropping or summer fallow. So they'll be like the rest of the green ones starting this year. So we'll be combining some databases there for you. Flax went from no type specified to spring. Staff will take care of the databases change. You guys won't really see a whole lot on that side of it. Canola added a spring hyaluronic acid, and this is a variety containing not more than 3.5% hyaluronic acid. So that was a change, a new kind of commodity. Some contract pricing change statements have been added here for our green counties, and that was basically eliminating some hauling expenses onto a contract there. And this was for mustard. Rate changes and T yield changes for all of these crops that are listed here. A lot of them saw T yield changes. Some had T yields that went up. We had some other crops in some counties that had T yields go down. Insurance staff does know about these things. If you have questions, don't be afraid to ask. Rate changes too will change premiums slightly. Okay, cat coverage. Cat coverage used to be a $300 fee. It's now at $655. That got changed in 2020. Now the question is cat worth it? It's probably going to be cheaper to go to an APH at like a 50-100 plan and probably pay less premium. So if you have a cat policy out there, you may want to take a look at it and look at just buying an APH plan. Malt barley. There's been some pretty good changes to the malt barley endorsement. Now, we still have 3 ways to insure malt barley. One of those is using your yield protection and using your contract price. Another is using straight revenue and RP policy. And the third way would be to use the malt barley endorsement. This allows you to use a contract price and have some revenue swing. Now, the problem with the malt barley endorsement in the past was you could get rejected and it was tough to reduce your bushels down enough. Now we're going to start using a local market price, which means we can reduce those bushels down a little bit more. Now, here's kind of how it used to work. In 2020, we would have taken the crop insurance harvest price for regular barley, and that was $266. Divide that by the 450, that would have been kind of your malt barley contract pricing. And when we took that out of there, we reduced your bushels down to about 591. The difference is now we're going to take local market price. What's that barley worth? That's going to be that 215. And we're going to divide that by that 450, your contract, basically the harvest price there. And that's going to reduce your bushels down to 477.8. That's a much bigger reduction. That makes this a little more attractive than it's been in the past. You do need to look at premium on this. Now, whole farm is still there. This is a product that basically puts all of your crops together into one. And it does go off of your tax history. So that's kind of a drawback. You got to turn a lot of tax history in, and it hasn't been quite as effective maybe this year with higher commodity prices. So it's still out there. If you have questions on it, please ask one of our insurance specialists. Now, SCO coverage. I did talk about this a little bit when we were talking PLC and ARC. And the reason is SCO does kind of mirror an ARC policy. And with higher prices, the potential for an SCO payment does increase because we could have price drop. And we're also in a little bit of a drier spell right now, which can trigger potential county payments. So here's kind of what we need to know about SCO. SCO is covering from 86 down to whatever level of coverage you have on your individual policy. But what you need to know is your individual policy will cover your bushels or your pounds or whatever it is. It covers your production on your farm. SCO is area based. That means this is a county coverage. It's covering from 86 to 75 because I have a 75 multi-peril policy on my individual side. So it's covering 11% on a county-based plan. But with higher prices, this might be something to look at. The problem with SCO is a couple things. Number one, the SCO is not free. You are paying premium for this. Number two, the premium is due in September. And you will not know if you're going to get paid until basically June of the following year. So if I buy SCO March 15th of 2021, my premium's due in September. I won't know if I'm going to get paid until June of 2022. But county-based plan, higher prices, it has some merit there, I guess. But that's kind of how that one works. Now, the other thing to know, if you want to buy SCO coverage, you have to be signed up for PLC for that crop. So SCO is bought by crop, and you have to be signed up for PLC basically at FSA for those acres you want to insure. And it's based off of your planted acres. That's what you're covering, is planted acres. All right. Now, ECO is somewhat similar to SCO. This is a county-based plan again. And the only thing is this one is a little bit more expensive than SCOs because the subsidy is not quite as good. And here's why. Rather than covering from 86, what we're going to do now is we're going to cover from 95% down to 86. And it's going to be covered again on a county-based plan. So if we wanted, we could buy individual coverage, and then we can buy SCO up to 86%, and then you could buy ECO up to 95%. So that's kind of how these works. As far as premium, due in September again, payments won't come out until probably June. So that's kind of a drawback, but it is a higher level coverage. You're covering kind of some of that profit, but you're covering the profit on a county-based plan. And some of these premiums can be fairly high. That's one of the drawbacks to it, but at least worth looking at and talking about a little bit. Okay, so that's ECO. Winter wheat. If you have any winter wheat acres out there, please let us know so we can get those turned in. We have to have some paperwork filled out here in March by the 15th, so make sure you let us know if you planted any winter wheat. Prevent plant. Hopefully we're not having any PP, but if we are, just a couple minor changes here that we've got to be aware of. First of all, the 1 in 4 rule is still there. You have to have the acres planted, harvested, and insured in one of the previous 4 crop years. So that has to be there. If you run out of eligibility, you got to plant it, harvest it, and insure it 2 years in a row. So be aware of the 1 in 4 rule. Now this is new for 2021. And this is basically that 2 crop history we used to have. What we're dealing with here is sometimes we plan on planting 1 crop in a field. It's too wet early. So I end up pushing back and planting a different crop in that field. What can now happen is we can claim PP on the crop we initially planned on in planting. So let's say on the 5th of May, I was planning on planting corn. It was wet, couldn't get it planted in. Stayed wet all the way through the end of May. Now it's June 5th. The ground is finally fit to plant. So I decided to plant some soybeans out there. I could still potentially claim PP corn, but I have to prove my intentions of planting that corn. Unless I have a 2 crop history, then I'm okay. So just be aware of those situations. That is there. And you will have to prove intent if you plan on utilizing this. And that could be seed receipts. You might have to put fertilizer stuff down. You're going to have to prove to the adjuster your intent if you claim something different than what's planted if you don't have a 2 crop history. Now, intended acreage reports, basically, if you're kind of a new producer in a county, you've never grown anything in that county, this is your opportunity to get some PP coverage. And what they've done is in year 1, you put an intended acreage report. Now you can revise it and put a new intended acreage report in your 2nd year based off of rotation stuff. So nice change there too. And the 1 in 4 rule got expanded to national. So be aware of that. It's there. Everybody has what we have. Now, cover crop statement. Basically, if we claim a PP crop, you cannot have corn as a cover crop. Covered corn is not an acceptable cover crop any longer on PP ground. Added land, just be aware of what you're adding. Talk to your crop insurance agent on this. Make sure we know where you're at and what you're doing. Anytime you're picking up new ground, let us know so we can get things ready to go. And make sure you let us know right away. Replant, before you replant anything, make sure you let us know. Contact your agent because we've got some work to do. So don't go out and replant until you've contacted your agent. New breaking, anytime you're breaking ground out, it's crucial that you let us know. We've got to make sure we've got our ducks in a row. And CRP, do note if you have CRP ground that we can do some things there for you. We just have to know about it. We want to get it planted in those first years so you can get 100% of the TEO. Precision farming data, we have a little bit of precision. We have companies that allow you to utilize your precision planting to do acreage reports. If you're interested in this, just let us know. There's some things we can do for you to help you out on that side of things. Hail insurance. We will be talking to you guys about hail. Remember, hail covers losses per acre. It can cover fire and vandalism, which your multi-peril doesn't. Each township has a different rate. We have a lot of different deductibles that we can talk to you guys about to help you try to save premium, try to get coverage that's going to fit what you're looking for. We've got some companion policies. We got a lot of things we can do for you on the hail side to help meet your needs. Now, sales closing reminders, please let us know any new crops you plan on planting, any changes to your operations. We need to know that if you're planting new crops, if you dug and brought new land on, broke any land out, if you're changing entities, you built an LLC, something like that, marital status changed. If you want to do it, utilize authority to sign. We want to talk options, ECO, SCO, all of those things. So be aware of that. Sales closing is coming up. We got a lot of things to cover. Options available. We do have direct deposit. We also have online pay. There's DocuSigns available with all of our AIPs that you can basically sign some of your claims paperwork digitally. So those things are all there to be aware of. Acreage reporting. The big thing here is as soon as you guys are done planning, let's get those acreage reports in early. If we have any issues, it's a lot easier to get those things taken care of when we have your acreage report in early. So make certain as soon as you're done, we get those done. Couple more things and then I'll get out of your hair. Claims reminders. Please turn your claims in early. Claims are supposed to be turned in within 72 hours of discovery. Now, I do realize we don't always know for certain if we have a claim, but here's some other basic rules. For production losses, they need to be turned in within 15 days of either the earlier date, the end of insurance date, or the day you're done combining. So if you think you have a loss, let's get that thing turned in early. Don't wait around till the end. I don't want to see anybody get denied because at 61 days, it will be denied. And at 16 to 60, it could still be denied. So like I said, get those claims turned in early from when you're done combining if you think you have a loss. Now on the revenue side of it, we have some pricing that comes in. So we don't always think we have a loss, but then all of a sudden, if the price drops, we could end up being in a situation where we have a revenue claim. There's 45 days to get that taken care of. So if you think you're close, let us know. We want to make sure we turn your claim in if we need to. Now, this is our writing area. If you have any questions on things I've talked about today, please get a hold of one of our crop insurance specialists and they'll help you out answering any of your insurance needs. We can run some quotes and we can take a look at a few things for you there. If you have any questions on the cash dividends or on the lending side, please get a hold of one of our loan officers. They'd be happy to help you out on that side of things as well. We deal with 6 companies and they all do a great job. We can utilize any of them. They have strong background. We should be in good shape by the backing and everything there. So with that, I will let you guys go. I appreciate your time and thank you for listening. And if you have any questions, please let me know or get a hold of one of our crop insurance specialists. They'll help you out. So thank you.